but you have to add inflation, because remember I said that ratio is in nominal space. So if you have 3% real growth and 2% inflation, let's say, you have 5% nominal growth. So now if you're living in a world where the debt is going up less than 3% of GDP and growth is going up, nominal growth is going up more than 3% of GDP, what's happening to the ratio? It's going down. It's, like I say, it was fifth grade math when I went to school. I'm not sure what they teach now, but basically, if your denominator is growing faster than the numerator, the ratio is going down. It's that simple. And if you see that ratio going from 125% to 120%, 115%, and so forth, it's still high. That's still really high. But if it's moving in the right direction, that will inspire confidence and basically help keep interest rates low and help the, basically maintain the reserve currency status of the dollar and help the U.S. Treasury market. So, and the oil thing is a little bit of an add-on, but what does 3 million barrels of oil per day additional production do? It lowers the price of oil. And what does that do? I said months ago, I was talking to Peter Navarro, I said, and he's a brilliant economist, but I said, if you want to end the war in Ukraine, get oil down to $40 a barrel, because that's Putin's pain point. We have not been able to put any pressure on Putin. The sanctions are a joke. I mean, they're not a joke. They actually boomerang on us. They hurt us. Right now, the Russian ruble is stronger than it was before the war in Ukraine started. The Russian economy is booming. The biggest problem is they have a labor shortage because everybody's working. They put it on a war footing. They're producing more, shells, tanks, cruise missiles, hypersonic missiles, etc., than NATO combined. So the Russian economy is doing fine. The sanctions have had no impact. But you take oil down to $30, $40 a barrel, that cuts their revenues in half. And now you put pressure on Putin. So that's how the kind of geopolitics of oil play out. I'm not sure that's the intent, but that will be the effect. So 333. But what it doesn't wipe out the debt. It doesn't make it go away, but it makes it sustainable by lowering the ratio and improving confidence. So that's Scott Bessent. Then we got our friend Peter Navarro. He's Mr. Tariffs. He's the trade and manufacturing czar, and we all know about tariffs. We kind of talked about those at the beginning. What do tariffs do? Well, there's the mainstream capital E economic profession view, and then there's what actually happens. It's usually the economists have no idea how the economy actually works. But so what would a mainstream economist say? So, like contributor to projects tend to get, or somebody from MIT or Harvard or wherever. They say tariffs are inflationary. And the Democrats sort of ran this theme in the 2024 election. Tariffs are a sales tax on the American people. Whatever the price is, you throw a 10 or 20% tariff on top of it. It's like a sales tax on the American people. And there was some intuitive appeal there, and that actually got some traction. They lost the election, but that idea stuck around. The idea is completely wrong, and here's why. So how do tariffs actually work? So you're a Chinese manufacturer, you make products, you've got a cost structure, you sell it to an American importer or distributor, and then they distribute it and they sell it to the consumer. You could have 5 parties, but they're the big 3, the producer, the importer, and the consumer. Who actually pays the tariff? Well, the importer writes the check. The port of entry, Port of LA, Port of Houston, you got to write the check to the Treasury Department for the amount of the tariffs. But who bears the cost economically? How does that cost get spread? The one place it does not go is to the consumer. Because if you're a distributor, Walmart, Target, anybody, if you could raise prices, you would just do it. Who cares about tariffs? You would just raise prices if you could. Everybody would. But they can't. The consumer's tapped out. Credit card lines are used up. Auto loan delinquencies are rising. Unemployment's going up. It's not a nightmare, but it's going up. Real wages are stagnant. Mortgage interest rates continue to remain high. There's just a whole long list of reasons why the consumer is tapped out. They can't raise prices. So who bears it? Well, they either push it back up the supply chain to the producer. Say, hey, sorry, producer, you have to lower your prices to me so that when we add the tariff, my net price is the same. Or the importer might bear part of it, or the importer and the producer the exporter and the importer, in other words, might share it. But either way, their gross revenues go down, their margins go down, but the one person who does not pay it is the consumer. So it's not inflationary. In fact, it could actually be deflationary if you're forcing producers to lower their costs, et cetera. So that's kind of how it works in practice. So it's not a sales tax. It's not inflationary. It does not hurt the consumer. It could reduce profits and gross revenues and margins at the exporter-importer level, but that's their problem. And so, but what does it do for the United States? What does it do for workers in the United States? Well, going back to what I said earlier, Trump said, well, you can sell to Americans with no tariffs. You just have to build it here. So now we're creating high-paying jobs in the United States in semiconductor manufacturing, automobile manufacturing, steel, other kinds of manufacturing. We're restoring the hollowed-out U.S. industrial economy, and they're not exclusively union jobs. A lot of them are, but those are high-paying jobs. So now you're giving real wages a boost, real incomes a boost. That helps consumption. That gets into a virtuous circle of promoting growth. So tariffs are a good thing. By the way, we don't have time to do the whole history, but from 1790 to 1962, this is how America grew. This was called the American system, started by Alexander Hamilton, carried on by Henry Clay, John Quincy Adams, Abraham Lincoln, William McKinley, and Dwight Eisenhower, and many other presidents in between. And now these things feed into each other, right? Because there are tariffs. I'm not saying tariffs. I'm not saying no one has to write a check. I'm just saying it's not the consumer. But when the importer and the exporter write the check, it goes to the Treasury. That's revenue. That helps the deficit going back to the 3 hours. So these things all sort of connect at some level. And then the third leg of the stool is the Mar-a-Lago Accord. Mm-hmm. And this is, by the way, I did coin that term. You go back to 2019, my book Aftermath, Chapter 6. The title of the chapter is the Mar-a-Lago Accord. So my readers were 6 years ahead of the curve on this one. I mean, today everybody's talking about it, and this guy, I'll get his name wrong, Zoltan Pozsar.
Zoltan Pozsar, yeah.
Zoltan Pozsar. He was at Credit Suisse, and he has his own, kind of research firm now. And Steve, but the big advocate is Stephen Moran, M-I-R-A-N. So who's Stephen Moran? Well, he was at a hedge fund, and he's an investment advisor, think tank guy, really smart guy, good analyst. But he's now the chairman of the Council of Economic Advisors. So he's in the White House. And he came out with a paper last November, just before, kind of right around election time. I'm not sure if it was just before or just after, but it's, I hate to do this to people, but it's 26 pages, single space, very densely argued, very technical. But I really urge everyone to read it, everyone who's interested in this. This is the Mar-a-Lago blueprint is in that Stephen Moran paper. It's not hard to find. He was at, I think it was like Hudson Bay Capital or Hudson something. But
I know. Yeah, there was definitely, I want to say Hudson, one of those.
Yeah, Hudson something. You'll find it. It's easy to find online. Read that paper. So what does he say? He says, put the tariffs on. So he's with Peter Navarro and Trump on that. So we need tariffs. But he makes a very interesting point, and it's a good one. You can manipulate the foreign exchange markets to offset the impact of the tariffs. I said earlier that the producer, the exporter bears some or all of the tariff. Okay. But what if I'm China and I cheapen my currency? I devalue my currency. In other words, the United